Welcome back to episode 4 of the $100 to $10,000 series. For the week, we are up 3.23%, and overall, we are up 4.84% since we started the series earlier this month. The market jumped on Monday as Moderna, a biotech company based in Cambridge, announced that their phase 1 study of their COVID vaccine was successful. A phase 1 study is done with a smaller sample group that are given low doses of the vaccine to check for side effects. The main focus in phase 1 trials are to see how the drug affects the body and how the body uses the drug to fight the virus. For this particular case, there were 45 subjects, and it was last reported that 8 out of the 45 participants developed antibodies that were found in people who recovered from the virus. On this news, Moderna stock rose about 30% in one day. That put the market cap of Moderna at over $29 billion. That's about 3 times more than the value of Lyft. This seems like a very high valuation for me, considering none of the projects in Moderna's pipelines are beyond phase 2 stages, and so the company is not really making any money. Even in their quarterly report, Moderna declared that, quote, "For the foreseeable future, we expect to continue to incur significant expenses and operating losses in connection with our ongoing activities," end quote. Not only that, some have voiced concern that Moderna has disclosed very limited information regarding the phase 1 study. For example, the results only disclosed that the 8 people developed neutralizing antibodies, but did not say whether it was the same for the other 37 subjects. And as doubts surfaced after the announcement, Moderna stock dropped 10% the next day. And a lot of big name retailers like Walmart, Kohl's, and Sam's Club reported earnings during the week. Walmart has been doing very well with its e-commerce platform, with revenues rising over 74% in the quarter, as people are stuck at home and are forced to shop at home. But as with other companies, its COVID-related costs dropped its profit margin a little bit. And on Wednesday, the CDC released a 60-page document regarding how America should go about reopening. In the report, CDC stated that it is working to equip state public health labs with sufficient testing equipment and materials. And the CDC outlined 3 phases of reopening, each with criteria to be met before moving on to the next phase. Looking at the threshold, the general pattern we see is at least 14 days of improvement in each category before moving on to the next phase. Childcare programs are expected to cancel all field trips and extracurricular activities, and ensuring that classes consist of the same group in order to limit exposure between different groups of people. And Dr. Anthony Fauci, who has served as the director of the National Institute of Allergy and Infectious Diseases, has reportedly supported a reopening of America, as continuing to keep the economy closed will cause irreparable damage. Although he supported the reopening of the economy, he said that the guidelines provided by the CDC must be followed closely and not all businesses may reopen immediately. And Dr. Fauci provided some optimism regarding the vaccine, making a hopeful prediction that a vaccine will be available in late 2020 or early 2021. The UK first sold $3.88 billion worth of its first negative yielding gilts, which are essentially bonds issued by the UK government. Normally, governments issue bonds as a form of borrowing money from investors, where they borrow a certain amount of investors' money and promise to pay them back with positive interest when the bond reaches its maturity date, most commonly after several years. But with negative yielding bonds, the investors are essentially lending money at a loss. This particular bond has a maturity date of 3 years at a yield of 0.003%. So, if you bought $1,000 worth of these bonds at the end of the 3 years, the government will pay you back only $999.97. So essentially, investors are lending their money by paying the borrower. But this isn't the first time this has happened. In fact, there were over $17 trillion worth of negative yielding debt in 2019. So why are investors lending their money at a loss? Some buyers of bonds, like banks, have to buy these bonds because they need safe, liquid investments. Others are basically betting that the price of these bonds will go up over time. Because bonds can be exchanged after being purchased, the value of the bond fluctuates on a daily basis, much like stocks. Buyers of these negative yield bonds rarely hold these bonds to maturity. Instead, they sell the bonds to someone else at a higher price. And these investors are betting on the fact that external circumstances, like quantitative easing, where the central bank buys government bonds to inject money into the economy to expand economic growth, will cause the value of these bonds to go up. So we can understand this behavior with the basic concept of supply and demand. As the central banks take away the supply of bonds, the price will rise as the bond becomes more rare. As always, thank you guys so much for watching, and please don't forget to hit the like and subscribe button.